Alright, this is part 4, part B. Closing the books, completing the cycle, and moving on. Now, we looked at this last time, the different steps in what we call the accounting cycle. Yes? So you record journal entries. In the journal, you post them to the ledger, and you prepare an unadjusted trial balance. It's called unadjusted because you haven't done adjustments yet. Then you record adjustments, accruals, and deferrals, post those into the general ledger, and then prepare an adjusted trial balance. And once you have all of the accounts adjusted appropriately, you can build the financial statements. Once we've done the financial statements, however, right, we are going to move on to the steps 8, 9, and 10 that we have not covered yet in previous videos. So, we need to record closing journal entries. We need to post those closing journal entries to the general ledger and prepare post-closing trial balance. Now again, I'm kind of skipping over trial balances in these videos to save some time. You can look up what a trial balance is. It's not a complicated thing to put together once you have a general ledger that is up to date. So, the rules for debits and credits, just by way of review, we have retained earnings, common stock, the two parts of equity. We have liabilities and assets. And then we have within, or kind of subcomponents of retained earnings, we have revenues, expenses, and dividends. Now, as we talked about before, some elements, right, are permanent elements or accounts, and others are temporary elements or accounts. The temporary ones here being highlighted by the pink letters, and the permanent ones being highlighted by the black. Now, when we look at the financial statements for a business, the temporary accounts are predominantly found in the income statement and retained earnings statement. The permanent accounts are our balance sheet accounts. So, here's our general ledger for Carl by the end of May, and this is where we finished with the last video. We look at the periodicity assumption here quickly because it's going to help us understand a little bit about the financial statements that we haven't quite nailed down yet. At the end of January, we're going to have a balance sheet prepared. At the end of February, we're going to have a balance sheet. At the end of March, we're going to have a balance sheet, and so on and so on. Balance sheets, right, are prepared for a specific period of time, a single date, right, at the end of January 31st, or at the end of February, or at the end of March. And so these are called position statements. That's why sometimes these are called the statement of financial position. Now, these are really snapshots. So you can kind of think of them as a picture, right? They don't explain a lot. It's not a video, right? It doesn't show what happened over time. It's just a snapshot at a singular point in time. But income statements and retained earnings statements are different, right? They show us the change, right? They explain part of the change, as cash flow does also. Explain the change between one balance sheet to the next. So my balance sheet at the end of January said this. My balance sheet at the end of February says this. What explains that change? Well, in part, the income statement and the retained earnings statement do that. So again, the income statement and the retained earnings statement, they primarily have our temporary account balances. They keep track of what happens over a period of time. The balance sheet is where we find all of our permanent accounts. Okay? The permanent accounts. Now, the process of closing, okay? Closing is the process of moving temporary account balances into a permanent account so that the company can account for the next period's revenues, expenses, and dividends starting from 0. Because revenue from April should start at 0. Revenue from May should start at 0, right? We start with 0 revenue and we count upwards. Same with expenses and dividends. So the point of closing is to zero out these pink temporary accounts so that we can start over. Now we can't just delete them. We can't just delete the balances, because then our whole equation becomes unbalanced. So we have to move the balances from those temporary accounts into a permanent account, and that account, as is here on the screen, is retained earnings. So here's all of our ledger accounts. Not all of them matter, because the ones we're going to close are only the temporary ones. So we have service revenue, repairs and maintenance expense, rent expense, supplies expense, and depreciation expense we talked about in the last video that we need to close. These are our revenues and expenses, the temporary accounts. What are we going to close them to? We're going to close them to retained earnings, which has a beginning balance of $67 from a prior periods. Okay? So our temporary accounts, revenues and expenses, permanent account, retained earnings. So in order to close these, right, we have to make them 0. So how do we make the service revenue 0? We need to debit it. How do we make all the expenses 0? Well, we're going to have to credit them. So the journal entry, the closing journal entry, letter M here, for the month of May, as we're looking at for Carl here, looks like this. Service revenue, debit of $425. Supplies expense, depreciation expense, repairs maintenance expense, and rent expense all get credited for whatever their balance amounts were, and the difference between the revenue amount on the debit side and the expenses on the credit side of $51 gets put into retained earnings. Now again, if you think about what's the difference between revenues and expenses, well, that's our net income, right? That's our profit figure. And what do we do with net income in our statements? We add it to retained earnings. And so once we post these, right, the $425 posts to service revenue becomes 0. The 20 to supplies expense becomes 0. The 4 to depreciation expense becomes 0, and so on. Retained earnings, getting the credit here of $51, means that the ending retained earnings balance for the month is $118, which should, if we look back, should match up to our retained earnings amount on the financial statements. So $118. I'm going to go back through the slides here real quick and see if that's where we're at. So here's our financial statements for May, right? And the final retained earnings balance, according to both the retained earnings statement and the balance sheet, is $118. So the closing process that we just looked at, this journal entry and its posting, the closing process is what actually makes our financial statements reflect what we say they should reflect. So our general ledger is up to date now. All of the temporary accounts have 0 balances, and we can start over with the month of June. Summary here. Closing process. Closing is the process of moving temporary account balances into a permanent account so that the company can account for next period's revenue, expenses, and dividends starting from 0. The accounting cycle. The set of steps followed in the preparation of financial statements and in keeping the books is referred to as the accounting cycle. This cycle is completed on a monthly basis for many companies. Closing is the final process completed in the accounting cycle. First, companies record and post transactions. Second, companies record and post adjustments. Third, companies record and post closing entries. So we have the recording process, the adjusting process, and the closing process. as always, and it's very important to remember,